There is a man named Eric in Sacramento who has been meaning to invest for 3 years. Not in the vague, someday I should way that describes most financial intentions that never materialize. In the active, research-heavy, genuinely engaged way of a person who reads financial news every morning, follows 3 market analysts on social media, has a brokerage account that has been funded but undeployed since April of 2022, and who has made the decision to invest the $34,000 sitting in that account approximately 6 times without ever executing it. In April of 2022, he was ready, and then the Federal Reserve announced its first rate increase, and the market dropped 8% in a week, and the timing felt wrong. In October of 2022, the market was down 25% from its peak, and he thought it might go lower still, so he waited. In March of 2023, he thought a banking crisis might cascade and held his position. In August of 2023, the market had recovered considerably, and Eric felt he had missed the entry point and wanted to wait for a pullback. In January of 2024, the pullback had not arrived, and the market was at a new high, and investing at an all-time high felt intuitively dangerous, so he waited. In September of 2024, there was an election coming, and election years feel volatile, and the timing was wrong again. The $34,000 has sat in his brokerage account, earning a money market yield of approximately 4.8%, while the S&P 500 has returned approximately 47% since April of 2022. Eric has not lost any money. Eric has not made any meaningful money either, relative to the alternative that was available to him every day for 3 years, and that he declined to access because the timing never felt quite right. The S&P 500 has not once, during those 3 years, been available to Eric at a lower price than it was on the day he funded the account and began waiting. The $34,000 that Eric deployed into a money market fund in April 2022 would be worth approximately $50,000 today if he had invested it in a low-cost S&P 500 index fund on the same day. Instead, it is worth approximately $40,000. Eric has not been waiting for the right time. He has been waiting while the right time passed, and then again while the next right time passed, and again, because the right time is a feature of past data and not of present experience. And in the present experience, the market always contains something that makes now feel like the wrong time to the person who is looking for a reason to wait. The psychology of market timing, the attempt to predict short-term market movements and enter or exit positions at the optimal moment, is one of the most extensively studied and most conclusively refuted behaviors in behavioral finance. The research on market timing is not ambiguous or contested. It is among the most replicated findings in the field. Dalbar Inc.'s annual quantitative analysis of investor behavior, which has tracked the returns of actual mutual fund investors versus the returns of the funds they invested in since 1984, consistently finds a performance gap of 3 to 4 percentage points per year between what the average equity investor earns and what the fund they invest in returns, a gap attributable almost entirely to the timing of purchases and sales. In 2023, the most recent year for which complete data is available, the average equity fund investor earned 21.39%, while the S&P 500 returned 26.29%. The 4.9 percentage point gap represents the annual cost of the attempt to navigate in and out of the market at opportune moments, rather than simply remaining invested through the full market cycle. Over 20 years, a 4.9 percentage point annual return gap on a $100,000 initial investment produces a difference of approximately $287,000 in terminal wealth between the market timer and the buy and hold investor. The market timer does not fail because they are unintelligent or uninformed. They fail because the problem they are attempting to solve, predicting short-term market movements from publicly available information, is not solvable by individuals or institutions with any consistency, and the attempt to solve it produces the specific pattern of buying high and selling low that generates the gap. Here is the reframe that makes every future news-driven investment hesitation feel different from every past one. The question of whether now is a good time to invest is not a market timing question. It is a math question. The math question is, given that you cannot predict whether the market will be higher or lower 6 months from now than it is today, because no one can, because the evidence that no one can is overwhelming and decades long, what is the expected cost of waiting versus investing immediately? And the answer to that math question, calculated from a century of market return data, is consistent across essentially every time period examined. The expected cost of waiting is positive, the expected benefit of waiting is negative, and the longer the investment horizon, the more decisively the math favors immediate deployment over delayed deployment. This is not an argument that the market always goes up in the short term. The market does not always go up in the short term. This is an argument that the inability to predict when the market will go up or down, combined with the historical tendency of the market to go up over any extended period, makes the waiting strategy a consistently inferior approach to the immediate deployment strategy. Not in every individual case, but in the expected value sense that should govern long-horizon investment decisions. Let me show you the data on what waiting actually produces compared to what investing immediately produces, because the numbers from the research are specific enough to change the behavior of anyone who sees them fully. The most comprehensive study of market timing versus immediate investment was conducted by Charles Schwab Investment Advisory and published in 2021. The study examined 5 hypothetical investors, each receiving $2,000 per year for 20 years to invest in the S&P 500, each following a different investment approach. The perfect market timer invested at the lowest point of each year, the best possible entry point, available only with perfect hindsight. The immediate investor invested on the first trading day of each year, regardless of market conditions. The bad timer invested at the highest point of each year, the worst possible entry point. The dollar-cost averager divided each year's $2,000 into 12 monthly investments. The cash holder never invested and held everything in treasury bills. The results over 20 years. The perfect market timer, who achieved the theoretically impossible task of buying at the exact lowest point every year, accumulated $151,391. The immediate investor, who simply invested on day one of each year without any attempt at timing, accumulated $135,471. The bad market timer, who bought at the worst possible moment every year, accumulated $121,171. The dollar-cost averager accumulated $134,856. The cash holder accumulated $44,438. The gap between perfect timing and terrible timing. The entire range of possible market timing outcomes from best to worst is $30,220 over 20 years. The gap between immediate investment and cash holding, the cost of waiting indefinitely for the right moment, is $91,033. Waiting for the perfect moment costs nearly 3 times as much as having the worst possible timing. The market timing problem is not that people pick bad entry points. It is that they substitute waiting for investing, and waiting is by far the most expensive strategy available to any long-horizon investor. The second data series that quantifies the cost of market timing is the missing the best days analysis. Bank of America research published in 2023 found that if an investor missed the 10 best trading days per decade in the S&P 500 from 1930 to 2020, their ending portfolio value was approximately $17,000 on an initial $1,000 investment. The investor who remained fully invested across the same period ended with approximately $962,000 on the same initial $1,000. The 10 best days per decade, roughly one great day every 300 days over 90 years, produced 98% of the total market return. The investor who was out of the market on those 10 days per decade, attempting to avoid downturns and re-enter at better prices, captured 1.8% of the return available to the investor who simply stayed put. The 10 best days cluster around the 10 worst days. The most dramatic recoveries immediately follow the most dramatic declines, which means the market timer who exits during periods of volatility to avoid further losses is precisely the investor most likely to miss the largest single-day gains that occur without warning in the days immediately following the exits. Now put two specific people through the same income, the same savings capacity, and two different investment approaches across 25 years, and follow the terminal wealth comparison to the number that makes the behavior change. Both are 30 years old. Both earn $78,000. Both have $800 per month to invest after expenses and retirement account contributions. Both are investing in the same vehicle, a low-cost S&P 500 index fund. The only difference is the investment discipline. The first investor, a woman named Diane, invests her $800 on the first business day of each month, automatically, without checking the market, without reading the financial news on the day of the transfer, without any attempt to assess whether the current market level is a favorable entry point. She has set up automatic transfers. The money moves on the first of the month and purchases shares at whatever price they trade at on that day. She does not watch the market. She does not think about the market between transfers. She does not make adjustments based on economic news, interest rate decisions, election outcomes, geopolitical events, or the sense of collective anxiety that periodically sweeps through the financial media and makes everyone feel that the market is at a uniquely dangerous moment. The second investor, a man named Mark, has the same $800 available each month. He also intends to invest in a low-cost index fund. But Mark reads financial news. Mark follows the market. Mark has the specific combination of financial literacy and market awareness that makes every current moment feel like a potentially bad entry point relative to a better moment that might be 6 weeks away. In a given year, Mark invests his $800 in 8 of the 12 months and keeps the money in a money market fund in the other 4 months. The months when the market feels elevated, when the economic data seems concerning, when a news event creates enough uncertainty that investing immediately feels imprudent. His 4 months of cash holding per year represent approximately 33% of his annual investment capacity, held at a money market rate that has averaged approximately 3% over the period. After 25 years, at an 8% average annual return for the invested months and 3% for the held cash months, Diane, investing fully every month for 25 years, accumulates approximately $730,000. Mark, investing in 8 of 12 months and holding cash in 4, accumulates approximately $563,000. The difference is $167,000. Mark did not panic sell during market crashes. He did not make dramatic allocation changes. He simply held cash for 4 months per year because the timing felt imprudent, a judgment that was wrong in its expected value, made consistently across 25 years at a total wealth cost of $167,000. The sources of the market timing impulse, the specific psychological mechanisms that make Eric and Mark and millions of other investors feel that waiting is safer than investing, are well documented enough in behavioral finance that naming them changes the experience of feeling them. The first mechanism is loss aversion, the finding from Kahneman and Tversky's prospect theory that losses feel approximately twice as painful as equivalent gains feel pleasurable. When you invest $34,000 and the market immediately drops 15%, you experience a loss of $5,100, a loss that, at twice-weighted pain, feels like the emotional equivalent of losing $10,200. When you hold $34,000 in cash and the market rises 15%, you experience a gain foregone of $5,100, an amount that, because it never appeared in your account balance, does not register with the same emotional intensity as a visible loss. The asymmetry in how gains and losses feel produces a systematic preference for the state of not yet invested over the state of invested and possibly declining, even when the financial math favors the invested state by a wide margin. You are not being irrational when market timing feels safer than immediate investment. You are applying a biologically normal loss-weighting function to a financial decision that requires suppressing that function to make the mathematically correct choice. The second mechanism is the illusion of control, the documented tendency for people to believe they can predict or influence outcomes that are, in fact, random or chaotic. Investing is an activity that involves reading information, forming assessments, and making decisions, all of the procedural components of skilled judgment. The experience of reading economic data, forming a view on market direction, and deciding to hold rather than invest feels like skilled analysis because it involves the same cognitive steps as skilled analysis in domains where the steps actually work. The problem is that the information available to individual investors, interest rate decisions, economic growth data, corporate earnings, geopolitical events, is fully reflected in current market prices almost instantaneously, because the market prices that information in real time across millions of participants. The individual investor is not analyzing information that the market has not already priced. They are analyzing information that the market has already fully digested and acting on an interpretation that they believe, incorrectly, is more accurate than the market's collective interpretation. The illusion of control makes waiting feel like analysis. It is not analysis. It is delay with an analytical costume. The third mechanism is narrative bias, the human tendency to organize random events into coherent causal stories that make the random feel predictable in retrospect. The financial news ecosystem produces a continuous stream of explanatory narratives. The market fell today because of weakness in manufacturing data. The market rose this week on strong consumer sentiment. Volatility has increased due to uncertainty around central bank policy. These narratives are accurate descriptions of what happened, and largely useless predictions of what will happen next, because the next market movement depends on the next piece of information rather than on the pattern of previous information. But the narrative explanations feel predictive because they are coherent and causal. And coherent causal stories are the primary input the human brain uses to predict the future. The investor who has read enough financial news to have a working narrative model of why the market is doing what it is doing has not gained a predictive advantage. They have gained a more sophisticated set of reasons to wait. The practical resolution to the market timing trap does not require becoming indifferent to financial information or abandoning all assessment of risk. It requires two specific structural changes that remove the decision from the emotional environment where it is most susceptible to timing impulses. The first structural change is automatic investment, the complete removal of the monthly investment decision from an active choice made in the present moment to a standing instruction executed without intervention. Automatic investment does not make you a better market timer. It eliminates market timing as an option in the moment when the impulse to time is strongest, the moment when the news is worst, when the market feels most unstable, when the voice that says wait for better conditions is loudest. The automatic transfer executes regardless of that voice. The shares purchase at whatever price they trade at on the transfer date. Over 12 months of automatic transfers, the average purchase price is the dollar cost average price, neither the lowest nor the highest price of the year, but consistently lower than the price a timer who waits for clarity will pay, because the timer who waits for clarity tends to achieve it after the recovery, not before. The second structural change is the information diet, the specific reduction of financial news consumption to the level that supports annual rebalancing decisions without fueling the weekly and monthly timing impulses that news-rich environments produce. The investor who checks the market daily and reads financial news continuously is not better informed about their long-term investment outcome than the investor who checks quarterly. They are more anxious, more susceptible to timing impulses, and more likely to make the behavioral errors that produce the 4.9 percentage point annual gap between what investors earn and what the market returns. Reducing financial news consumption is not financial ignorance. It is the specific information management practice that the research on investor behavior consistently identifies as a predictor of higher long-horizon investment returns. The lump sum versus dollar-cost averaging question deserves direct address because it is the specific form the market timing debate takes for investors like Eric, who have a large sum available to deploy at once rather than a monthly contribution stream. The research on lump sum versus dollar-cost averaging is unambiguous. Across approximately two-thirds of historical rolling periods, lump sum investment on day one produces higher terminal wealth than spreading the same sum across 12 monthly installments. This is the expected result given that markets trend upward over time. An investor who deploys capital immediately participates in upward market movements that begin before the dollar-cost averager has finished deploying. The one-third of historical periods where dollar-cost averaging outperforms are the periods that begin immediately before a significant market decline, the circumstance that feels most likely to any investor who has been reading economic news and has convinced themselves the market is overvalued. The problem is that the periods that feel most like impending declines are not, in aggregate, more likely to precede declines than any other periods. The feeling is not signal. It is the narrative bias and loss aversion mechanisms in operation, wearing the costume of prudent risk management. Eric's $34,000 is still sitting in the brokerage account. It earns 4.8%, while the alternative earns its historical 10% average. And the gap between those two rates, applied to $34,000 over the remaining 35 years of Eric's investment horizon, is approximately $540,000 in terminal wealth. Not from this year's gap alone, from the compounding of each subsequent year's holding at money market rates, while the market compounds at equity rates, extending the 3-year delay indefinitely because the mechanism that produced the delay has not changed, and because the market will always contain something that makes now feel like the wrong time to someone who is looking for the right time. Eric is going to read the financial news tomorrow morning. There will be something in it: a Fed statement, an inflation print, a geopolitical development, an analyst's warning that will feel like a reason to wait a little longer. The reason will feel specific and credible, and different from the previous reasons, which were also specific and credible, and which, in retrospect, were all wrong about the direction of the market in the subsequent months. The next reason will also be wrong. The market will do what the market does regardless of the reasons, and the $34,000 will continue earning 4.8%, and the gap between what Eric's money is earning and what it could be earning will continue widening, and the decision to invest will continue being postponed to a right time that exists only in the past, available in every month that has already happened, and unavailable in every month that has not yet arrived, which is the permanent condition of a market timer, who is always